Are you thinking about buying a business? There's a hidden financing tool that sounds great on the surface, but that can lead to financial headaches later on. The seller carry note on full standby. In today's video, I'll explain what it is, how it impacts the SBA loan, and the potential risks you need to know before signing on the dotted line. Stick around because understanding this could save you from making a costly mistake down the road. So what is a seller carry note on full standby? A seller carry note on full standby is when the seller agrees to finance part of the purchase price. Sounds great, right? Well, the catch is that the buyer doesn't have to make any payments on the note for a set period of time, usually about 2 years. On the surface, it's a great way to improve cash flow right after buying a business. But is it as good as it sounds? Let's find out. The first thing you need to understand is that the debt service coverage ratio, or DSCR. This is the measure lenders use to decide if your business generates enough income to pay its debts, as well as pay you a living expense. A healthy DSCR is crucial. If you're buying a business with a low DSCR and banking on future growth to improve it, you're taking a huge risk. In fact, during the standby period, the seller note doesn't count against DSCR, which can make the difference and make your loan look better than it actually is. So how does it impact the SBA loan? Let's break it down. In short term, the standby period makes things look rosy. No payments on the seller carry note means more immediate cash flow, which could make the deal more appealing to lenders. But after 2 years, that debt doesn't just go away, it piles up. You have to then start servicing it. If the business's cash flow doesn't improve enough, you're now on the hook for a bigger chunk of debt than you had originally planned and that you were used to paying for. Let's look at an example. You're buying a business for $500,000. You get an SBA loan for $400,000. The seller agrees to a $100,000 seller carry note on full standby for 2 years. The business generates $120,000 in cash flow per year. In the first 2 years, you're only paying the SBA for a loan, which is $50,000 a year in this example. Your DSCR is a very healthy 2.4, which looks great. But when that standby period ends, you now have to pay both the SBA loan and the seller carry note, bringing your total debt service to over $70,000. Your DSCR drops to 1.71, which is still healthy and it's acceptable. But what happens if your cash flow doesn't grow? You're now in a much tighter situation. The biggest issue facing many buyers is they assume that the business will perform better in the future. But what if it doesn't? The standby period gives you a false sense of security, and many buyers feel blindsided when they suddenly have to start making payments on both loans. If you don't plan for the worst case scenario, you could end up in a financial strain that puts your entire investment at risk. Now, don't get me wrong. I'm all for structuring these notes and helping buyers and sellers accomplish what they're looking to do. The point of the video is make sure that you're going into a business with the experience and the expertise that if you do a seller carry note on full standby, that you really can grow the business and you know how to grow that business because you have the experience and the expertise to do exactly that. Then these notes became a fantastic tool to help you get into a business with a lower down payment, defer, and have more cash flow at the beginning while you focus on the first year or two growing that business so that in 2 years, the business is significantly more profitable than it was. And in that case, it's a win-win situation. If you're looking at buying or selling the business, reach out to me. I'd love to help you through the process. Thanks. Take care.